Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So interesting article comes out from Forbes. It says Wall Street has been quietly cutting 20,000 jobs in 2023. So the start of the article basically says top banks in the US are quietly cutting 20,000 employees throughout 2023, and they say more job losses are coming according to CNBC. Now, this is a worrisome sign because, banking industry, it's known to be very strong, very stable, right? Although we did have the regional bank issue in the start of this year, which was pretty shocking. Well, kind of, depending on how you look at it. But definitely all this tightening, all these rate hikes, all the QT and so on has been disturbing the economy, the markets, and many businesses as well. And like we've heard during the regional bank issues as well, with the losses that they're taking on their balance sheet, with the bonds, right? Even not just the regional banks, the regular top banks as well, that are reporting paper losses on these bonds. Although, yes, you could argue that the Fed stepped in and they said that, you can raise those losses and bring them back to par because you're going to be backed up 100% on all those bonds. But the key thing is that even with the support that they received back in March of this year, early of this year, you still got job losses happening in the banking sector. So they're still cutting jobs there. Right? And Wall Street is known. They're known to strive and thrive on investment banking, on deal making, on IPOs, mergers and acquisitions, right? Trading and asset management also, right? This is all an area where they make a lot of money from this area, right? But it's been on a decline, and Wall Street is feeling it, and the banks are feeling it. Now, what are the main reasons for these cuts, right? 20,000 so far and more to come. Well, it has to do all with these higher interest rates. Like I said, fears of also possibly a recession. We've heard two big hedge fund Wall Street traders out there, Bill Gross, saying that they expect a recession end of this quarter this year, right? We also heard Bill Ackman, who was shorting bonds and saying that bonds are going lower and the rates are going to go to 7%, which can still happen. But he covered his short, took profits on his short because he believes that, there's more risks now. And the risks are adding up. And you're seeing that. You're seeing that in auto delinquency rates going up. You're seeing it like in the past with the regional bank issues. You saw it with the whole UK pension funds almost going bust last year. These are all points that are adding up, that things and stress are accumulating. They're accumulating, and Wall Street and the top banks are seeing that, hey, we could see a recession and we need to start slashing jobs. We need to start cutting the cost. We need to start increasing those profit margins, getting better and so on, and improving forward. Now, on top of that, there's also an expectation that artificial intelligence, automation, these are a couple of things that are emerging and will help improve efficiency and reduce costs. So basically, the high-priced bankers and traders won't be needed as much as in the past because of this AI and automation. And, with new technology and with AI and so on, people expect that this next recession to be short-lived, and we could see a nice bounce very quickly because of what automation, AI technology can do. It can reduce the cost, right? And it can help you strive further and farther, especially when you have you're more efficient in your work. So in other words, the cost all around will be much better. That might help with, also even with inflation will be much more better because you're more efficient. You're using technology, which is costing you less. You're not paying for, those high priced bankers, which is kind of a negative for the banking sector, for anyone who is trying to get a job in this role, right? Coming out of school. From studying finance and so on. A lot of these people will find that it's getting tougher and tougher to get a job because there's less banking jobs out there, and a lot of them, these analysts and so on, are being replaced by technology and AI, right? So this is a trend that is happening, and that's where you can expect more demand for maybe people in this field of AI and automation as this recession takes place, as people start to think that, okay, how can we reduce our costs? Inflation's high up there. Can we use technology? Can we replace these jobs with AI and automation? We heard also from IBM say the same thing, the CEO saying that a lot of the jobs, he exactly said a lot of the jobs in IBM can be replaced with automation and AI. Talking also about the HR industry as well, can be fully automated and so on. And also some talks about some tech jobs that could be also replaced by AI and automation, right? So, down the road, you may think, okay, this recession is pretty bad. Job losses happening. They're cutting jobs. They're reducing jobs as well. And on top of that, you have this technology and AI. Well, the job component, the loss of jobs, should eventually play into the inflation data, bringing it down. But technology also, AI, would also help alleviate some of that inflation pressure and bring it down lower, which you may have maybe deflation at one point, right? That's a very much of a possibility in the next recession. Now, the rebound that would come from the drop and then, the next move up would be probably maybe the technology advancements, the better earnings that these companies are going to post in the future because they're reducing the cost. Although there will be people who lose their jobs and they may have to find a new area, a new job or a new basically field to fit in. But however, in terms of the cost side of things, with technology, recession, hard landing, and all of this, that should alleviate the pain that we've been seeing with higher inflation. So all of this, basically, what I'm trying to convey here from this article is, one thing is that dozens of jobs in the banking sectors is a red flag for what is to come short to medium term. And second, looking forward after all of this with AI and automation, and with this rinse of all the money printing that happened and the high inflation, that should also alleviate and get better for a nice trajectory long term. But until then, there are red flags, there are issues with the banking sector, with the job cuts, with commercial real estate, etc., and we'll continue to monitor and see how this plays out in the coming months, and whether even Bill Gross is right about Q4 being the recession, right? Or we might just find out later after it happens. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.